At first glance, the title of this video might seem a little bit sensationalist to suggest the value of your cash is falling. However, what I'm referring to is inflation. If you're unfamiliar with the concept of inflation, basically it means what you can buy with the pound in your pocket today versus what you can buy with the pound in your pocket in the future. So things rise in cost, costs rise over time, and that is inflation. Now in the UK we use two different things to measure inflation. We use the retail prices index and we use the consumer prices index. The difference between the two: the retail prices index includes housing costs and is a simpler calculation. The consumer prices index doesn't include housing costs and uses a slightly more complex calculation. That means it will pretty much always come out lower than the retail prices index. But anyway, those are the measures that we use in the UK for inflation. Now at the moment we're going through a period of particularly low interest rates. So if you are getting a lower return on the cash you have in the bank than the rate of inflation, whichever measure you choose to use, then the value of the pound in your pocket is reducing, meaning that you can buy less with it than you could when you put it in the bank in the first place. Now, to illustrate this, I'm going to look at a couple of charts which should be up on your screen now. The first chart simply compares the UK retail prices index, which is A, which is the green line on the chart, and B, the consumer prices index, against the Bank of England base rate. So you can see over time how the rate of inflation has significantly surpassed the Bank of England base rate. Now, on the next chart, again, we can look at the same three things. A is the UK retail prices index, B is the consumer prices index, C this time though is the Bank of England base rate plus 0.5%. So if you always manage to achieve an extra 0.5% from your savings versus what the Bank of England base rate is, which is shown as D, the green line on this chart, that's what your return would be over time if you had £100 starting out in March 06, so 15 years ago, to now. You can see that the value of that cash is significantly lower than the purchasing power it had in March 2006 based on both the retail prices index and the consumer price index. And even if you always manage to get an extra 0.5% on your savings versus the Bank of England base rate. Now on the final chart, I've added one extra thing on there. I've added a FTSE UK all share tracker just to show you how generally over time investments will outperform inflation. Now, I'm not suggesting that this is the perfect investment for everybody. It certainly isn't. But I thought it was a good tracker to use simply because it also shows the ups and downs of that market. And that leads us on to the next point. You do still need cash savings. Everybody does. You need cash in the bank available for emergencies and for anything that you've got planned expenditure for the next, say, 3 to 5 years. You should only invest money with a long-term view, because as you can see from that chart, investments, unlike cash, do go up and down in value. Cash should, in theory, maintain at least its pound value, but not necessarily its purchasing power. Of course, we're now talking about negative interest rates coming to the UK, which might change that a little bit. But generally speaking, cash will maintain its pound value. So if you have planned expenditure that you know you're going to need to buy something in the next 3 to 5 years, and simply for emergencies, then you do need cash in the bank. But what a lot of people do is they have far too much cash in the bank, more than they really need to. And those people would benefit from sitting down and working out how much cash they really need and the money that they can afford to put aside for the longer term, investing that money. Now, there are different levels of investment, different levels of risk. Some people do want to do nothing more than try and outpace inflation, and that's absolutely fine. Now, converting savings to investments, obviously I, as a financial advisor, would recommend that you came to somebody like myself in order to do so. But there have been things been put in place recently which make it easier than ever. You can actually convert cash ISAs to investment ISAs without losing the ISA protection. I would urge anybody to sit down and think about, do you really need as much cash on hand as you have on hand? Then, probably with a financial advisor, sit down and talk about the level of risk that you're prepared to take with the money in order to try and achieve the long-term returns you need to preserve your wealth and to hopefully increase it. If you have any questions, drop me an email, use the comment section below, etc. Speak to you soon. Take care.